Welcome to the deep dive. Today we're tackling a really transformative trend, asset tokenization. Think of it as taking traditional assets, stocks, bonds, funds, and putting them onto a blockchain. It could seriously reshape finance.
Absolutely. And we're going to focus a bit on Connexes by JP Morgan. You might remember them as Onyx. They're really at the forefront here.
Right. Connexes digital assets, or KDA. They've already done some pretty amazing things, haven't they?
They really have. We're talking over $1.5 trillion facilitated in trading and settlement.
Wow, 1.5 trillion.
Yeah, using tokenized versions of things we know, like U.S. treasuries, money market funds.
Yeah.
But what's really cool is how it enables new stuff, like intraday borrowing, getting funds just for a few hours, and making margin management way simpler.
That sounds incredibly efficient.
Yeah.
But 1.5 trillion, while huge, still feels like early days compared to the whole market.
Oh, completely. It's a tiny fraction, really shows the massive potential. But yeah, we're just scratching the surface.
So, okay, they've proved the tech works. What's holding it back from really, exploding, becoming totally mainstream?
Well, Connexes put out this fascinating report, Project IPIC, and it points squarely at two things: on-chain privacy and identity management.
Privacy and identity. The critical missing pieces, basically.
That seems to be the core argument. Without solid solutions for those, the full potential just stays locked up.
Makes sense. I mean, you need better privacy to bring in let's say, the really big traditional finance players, don't you? They need that data protection.
Exactly. That's non-negotiable for them. And then efficient identity management. That's the key to making it all scale up smoothly, making it user-friendly.
And Connexes hasn't just stumbled upon this, right? They've been thinking about this stuff for a while.
Oh, yeah, for years. Way back in 2017, they were developing the Zero Knowledge Security Layer, CSL.
CSL, right.
Then 2019, the Anonymous Tether Protocol. They worked with Singapore's Monetary Authority in 2022 on institutional DeFi.
I remember that report.
Plus, they open-sourced their self-sovereign identity SDK, and last year looked into the future of wealth management.
Okay, so Project EPIC feels like the next logical step in this journey they've been on.
Precisely. It really digs into their viewpoint on how privacy, identity, and this idea of composability, how things fit together, are just vital for asset tokenization.
Composability. We'll need to unpack that one.
We will. The report, it tries to lay out the challenges, the opportunities, but also, get the whole industry talking.
And the timing seems deliberate, too, with this growing focus on tokenizing funds.
Yeah, definitely. There's a big push starting around 2024 onwards to look at fund tokenization for smoother operations, better distribution. So the report lands right in the middle of that growing interest.
Okay, so our mission for this deep dive, understand why. Why are privacy and identity the absolute keys to taking asset tokenization from billions, maybe to trillions? We're going to lean heavily on this Project EPIC report for insights.
Sounds like a plan.
Right, let's start with this multi-trillion-dollar potential. It sounds incredible, but why exactly are privacy and identity the big bottleneck?
Well, the projections for market growth are just staggering. Multi-trillion dollars isn't hyperbole in some forecasts,
Right.
but actually getting there. That absolutely depends on having, institutional-grade privacy, ways to protect sensitive financial data on the blockchain.
Which traditional finance absolutely demands.
Absolutely. And alongside that, you need these composable, privacy-preserving identity solutions, systems that work together smoothly, verify who's who, but without, leaking private data everywhere.
So without that robust protection, the big money just stays on the sidelines.
Pretty much. It really constrains how fast this industry can expand and makes it harder to attract those major traditional investors.
Interesting. Now, KDA, Connexes Digital Assets, they're already doing, what, $2 to $3 billion a day on their own permission blockchain?
Yeah, that's right. Significant volume. And it definitely validates their strategic choice of using an EVM-based permission network.
But at the same time, we're seeing more traditional asset managers starting to experiment on public blockchains too. What's the story there? Is it an either?
It's more of a both-hands situation, I think. There are really two main drivers pushing asset managers towards public chains. First, it's the potential for operational efficiency gains, faster settlement, less back-office hassle.
Okay.
But the second, and maybe equally important, is accessing new distribution channels, specifically tapping into that crypto-native investor base.
Reaching a different audience.
Exactly. But here's the crucial thing. Whether they're on a private chain like KDA or a public one, whether they're chasing efficiency or new investors, the fundamental needs remain. They still need mature on-chain privacy, and they need some kind of consensus on how digital identity works while preserving that privacy.
And those solutions aren't quite there yet.
Largely, no. Not at the level traditional finance requires. And that creates friction, slows things down, limits who's willing to really dive in.
Although we are seeing some activity on public chains already, right? You mentioned on-chain funds raising a few billion, and stablecoins are huge, around $200 billion.
Yeah, that's true. There's definitely activity, which suggests there is a market segment, perhaps participants with, let's say, different priorities or maybe a higher tolerance for the current state of privacy and identity tech.
So early adopters, maybe? Or those focusing on different use cases?
Could be. It highlights that needs aren't uniform. The existing public chain activity probably reflects demand from folks who are okay with more transparency or the current identity methods.
But for the big institutions, the pension funds, the sovereign wealth funds.
For them, data privacy isn't a nice to have, it's foundational, it's table stakes. The big benefits of tokenization efficiency, access they won't fully materialize for that massive pool of capital without really solid integrated privacy and identity solutions.
And Boston Consulting Group backs this up. They see huge growth potential if these hurdles are cleared.
Yeah, BCG projected something like $30 trillion in AUM growth globally in just the next few years. And they believe a big chunk of that could potentially be tokenized if traditional investors get the comfort level and the tools they need. Which brings us back to privacy and identity.
So what's Kinexy's vision here? How do they see this working? Can you have both transparency and confidentiality in this tokenized future?
That's exactly the goal. Their vision is a future where you can transact efficiently and privately and build new things, whether you're in a public ecosystem or a permissioned one.
Okay, so how do they break that down? Let's start with solving for privacy.
Right. So the current state. Public blockchains are generally transparent, maybe pseudonymous at best, right? Your address isn't your name, but anyone can see the history.
Yep.
Permission networks like KDA offer operational privacy through access controls. You decide who sees what, but that can limit how widely things are distributed and doesn't quite offer the same level of trust minimization as a fully public chain.
Okay, so what's the target state for privacy then?
The ideal is a unified ledger where participants can choose to shield their sensitive financial info. The fact a transaction happened might be visible, maintaining transparency, but the specifics who, what, how much remain confidential if needed.
Balancing transparency and confidentiality.
Yeah.
Got it. Now, solving for identity. What's the problem there?
The big issue now is the lack of standard ways to verify identity on-chain that work everywhere. It leads to really redundant processes.
Like doing KYC checks over and over again.
Exactly. An investor might onboard with one manager, then another, and have to go through the whole know your customer process each time. It eats away at the efficiency gains tokenization promises.
And what makes identity tricky in the current digital world, especially with blockchain?
Well, first, the trustworthiness often ties back to who did the verifying. Second, traditional identity systems often don't play nicely with blockchains. And third, putting actual PII, personally identifiable information, directly onto a public chain is generally a huge no-no for privacy and security.
So what's the target state for identity?
Repurposable digital identities. Imagine getting verified once, properly, by a trusted entity. Then you can use that digital proof securely and efficiently across different platforms, different funds, different services, all while still meeting compliance rules.
That sounds like a game changer for onboarding.
It really could be. And the third piece they highlight is preservation of composability.
Right, composability. Let's define that. Like Logo bricks.
That's a great analogy. Composability is basically how easily you can take different components, different financial bricks, and combine them, build on top of them, create new things.
Okay.
Blockchain and tokenization really enhance this because you can represent assets and processes as modular bits of code, reusable code. That drives innovation, automation.
So tokenizing an asset makes it easier to plug into other systems.
Precisely. It makes it easier to move, to settle, to service. You can then build purpose-built applications on top for financing, trading, using assets as collateral much more easily.
We see that in the crypto world already, right, with DeFi.
Absolutely. The EVM ecosystem, Ethereum, and similar chains is a testament to the explosion of innovation you get from modularity and letting these components interact autonomously.
So the key point is that good privacy and identity solutions shouldn't break this composability.
Exactly. They need to be designed to actually complement and even enhance it. They shouldn't create new silos. They should allow these private verified assets and identities to still plug into that Lego ecosystem.
Okay, that framework makes a lot of sense.
Mhm.
So Project EPIC, this proof of concept initiative, what were its specific goals? What were they trying to achieve?
They had four main objectives. First, just validate the need. Do institutions really see privacy and identity as critical for tokenization? Spoiler, yes.
Okay.
Second, figure out the criteria for a good identity solution, one that can scale and work effectively. Third, actually explore some of the new privacy technologies out there. And fourth, try to bridge the gap between, traditional finance needs and the Web3 way of thinking.
And they grounded this in real business problems, not just theoretical tech.
Yes, very much so. They focus specifically on the investment funds ecosystem, building on that earlier future of wealth management work.
The one about collapsing thousands of steps into a few clicks using smart contracts.
That's the one. That report showed huge potential efficiency gains, but also underscored that you need scalable privacy and robust identity to make it work securely and compliantly at scale.
So why the specific focus on investment funds within Project EPLA? It's a huge industry, obviously.
It is. We're talking $98 trillion in global assets under management. But despite its size and evolution, it still struggles with significant operational inefficiencies.
Like what?
Well, think about investor onboarding, often slow, paper-heavy. Data lives in silos, systems don't talk to each other easily, lots of manual processes, reconciliation headaches, high costs.
Right, I've heard about that.
So blockchain and tokenization offer this compelling path to modernization. A shared, immutable ledger, smart contracts, automating tasks. It could really streamline things like reconciliation, AML KYC checks, moving cash around.
And we are seeing the beginnings of this. You mentioned about $13 billion in traditional assets tokenized already.
Yes, around that figure. Still tiny, less than 0.01% of global AUM, but it's accelerating.
And are there tangible benefits being reported by those early movers?
Definitely. We're seeing examples like Franklin Templeton projecting huge cost reductions for processing transactions, like comparing maybe $1.52 per transaction versus $50,000 using older methods for a large batch.
Wow, that's significant.
And Hamilton Lane has been able to drastically lower investment minimums on some tokenized funds, opening them up to more investors, then going from $2 million down to $10,000.
Okay, that democratizes access.
Exactly. And there are quotes in the report, like from Nihilus Sudrania at Firmidium, estimating onboarding efficiency could improve by maybe 60%, even up to 90% if you can reuse KYC information.
Those are really compelling numbers. So, given that potential, let's dive deeper into the specific privacy worries for investment funds going on-chain.
Okay, several key concerns come up. First is what's called alpha protection.
Protecting their secret sauce.
Essentially, yes. If a fund's specific holdings are visible in real time on a public blockchain, competitors could potentially copy their strategies, eroding their edge, their alpha. It's very different from current regulations where holdings are disclosed with a lag.
Makes sense. What else?
Another is preventing potential runs on funds. If everyone can see large redemption requests happening in real time, it could theoretically trigger panic selling, maybe leading to liquidity issues, especially for less liquid assets.
Like a bank run, but for funds.
Kind of, yeah. Then there's just basic investor privacy. There are legal mandates like GDPR, PDPA in Singapore, CCPA in California about protecting personal data. Plus, investors generally prefer their transactions and who they invest with to remain private.
And manage investor relationships.
That too. Full transparency on ownership ledgers and maybe even fee structures could potentially complicate relationships between fund managers and their investors.
Okay, so significant privacy hurdles. What about the identity side specifically for funds?
Well, KYC and AML, know your customer. Anti-money laundering are absolutely non-negotiable. Regulators demand it. And transfer agents are usually the ones handling this.
And that process is painful now.
Often, yes. The report mentions figures suggesting it's laborious, costly per onboarding. Think hundreds or thousands of employees at large, transfer agents focused just on this.
Why it's so complex?
Evolving regulations, different rules in different countries, lots of back and forth communication, and crucially, it's duplicative for the investor. Onboard with Fund A, then Fund B, Fund C, often starting from scratch.
Right. There are quotes in the report reflecting this sensitivity.
Yes, Stephen DeMello from Albarn mentions the real sensitivity around privacy for things like who's redeeming, who's subscribing, who's co-investing. And Robert Mitchnick from BlackRock stresses applying traditional KYC rigorously, but while preserving privacy in this new tokenized world.
So the ideal is some kind of reusable digital identity.
Yeah.
Maybe managed by a network of trusted players.
That's a key idea explored. A network of trusted institutions, transfer agents, administrators developing digital-first standards, maybe using decentralized identifiers, VCs. They could even potentially charge small fees for using these verified credentials, creating a business model, and maybe automate compliance checks, like ensuring a fund doesn't exceed ERISA ownership limits.
Interesting. Okay, let's bring composability back in. You said tokenization makes assets more composable, but not necessarily more liquid. Can you expand on that for funds?
Sure, tokenizing a share in, say, a private equity fund makes that share technically easier to transfer and integrate into other digital systems. That's the composability. But it doesn't magically create more buyers wanting that specific share right now. That's liquidity.
But composability could enable better liquidity down the road.
Exactly. A key potential application, especially for traditionally illiquid fund investments, is building better secondary markets.
What stops those markets from working well now?
It's often clunky. Poor user experience, lots of negotiation, NDAs, slow settlement. It's not like trading stocks. But imagine combining on-chain composability with these privacy and identity solutions. You could potentially streamline a lot of that.
How would that work practically in a secondary trade?
Right now, it's often bilateral negotiation. Buyer and seller find each other. A big hurdle late in the game is the buyer having to go through full AML KYC with the fund administrator.
Right, more delays.
Yeah. And sellers often have to sell at a discount to the net asset value, the NAV, which, if that happens transparently on a public chain, could cause headaches for the fund manager.
So how does tokenization plus privacy identity help?
You could build a secondary market application on top of these tokenized funds. Smart contracts could enforce rules like only bidders who have already passed KYC checks, verified via their digital identity, can even participate.
So you filter up front.
Exactly. That could massively speed up settlement and potentially create a more efficient market with better pricing. Mike Stevens from JP Morgan is quoted highlighting just how repetitive and inefficient today's KYCM process is across different transactions. This could fix a lot of that.
Okay, we've clearly established the why, the critical need for privacy and identity. Now, let's get into the how. What are the main technical approaches to privacy that Project Epic looked into?
Yeah, the tech deep dive. A key distinction they make is between on-chain and off-chain privacy.
Okay, what's the difference?
Off-chain privacy means keeping the sensitive data separate from the main blockchain ledger, using things like data segregation, controlling access, maybe separate subledgers, or even trusted execution environments, TEEs.
Like secure hardware enclaves?
Exactly. This is common in private or permission chains, like KDA uses some of these principles. But the downside is relying solely on off-chain can sometimes undermine blockchain's core benefits.
How so?
Well, it can hinder decentralization, create new data silos that limit interoperability, TEEs aren't always fully transparent, and using private channels can kind of undermine the single source of truth idea.
Okay, so what's on-chain privacy?
That uses advanced cryptography and mathematical magic, basically directly on the blockchain itself. Things like zero-knowledge proofs, ZKPs, fully homomorphic encryption, FHE.
So the privacy is baked into the public ledger.
Right. The beauty is, even if you can see the whole ledger, the cryptographic methods prevent you from deciphering the transaction details or the identities involved. Ideally, it doesn't rely on trusting intermediaries in the same way off-chain might.
And the report focused on techniques compatible with the EVM, the Ethereum virtual machine.
Yes, that was a practical focus. Since KDA uses an EVM base, and so much innovation is happening in the Ethereum world, it makes sense to look at solutions that work there.
So which specific on-chain technologies did they zoom in on for the proof of concept?
They narrowed it down to three main ones: zero-knowledge proofs, ZKPs, stealth addresses, and fully homomorphic encryption, FHE.
Okay, let's break those down. Zero-knowledge proofs, ZKPs. What are they in simple terms?
Okay, a ZKP lets you prove something is true without revealing anything else besides the fact that it's true.
Like proving, a password without showing the password.
That's a classic analogy, yeah. Or proving you have the key to a lock without showing the key. For blockchains, you can use ZKPs to prove, say, I own these tokens, or I have enough funds for this transfer, or even I am over 18, all without revealing which specific tokens, the exact amount, or your actual age or identity.
That sounds powerful. How does it work in a transaction?
Let's say Alice wants to send tokens to Bob privately. Alice creates a transaction that includes a ZKP. This proof mathematically demonstrates she has the right to send the tokens, she owns them, has enough, intends to send to Bob.
Okay.
A smart contract on the blockchain verifies this proof. Crucially, the contract can confirm the proof is valid without seeing the underlying data, amount, identities. Once verified, the contract updates the balances on the ledger, but often in an encrypted way.
So only Alice and Bob know the outcome.
Right. They use their private keys off-chain to decrypt their new balances. Observers just see a valid transaction occurred, but not the details.
Very clever. What about stealth addresses? How do they provide privacy?
Stealth addresses tackle privacy differently. It's about obfuscating the link between the sender and the receiver on-chain. It's a standard, ERC 5564.
Okay.
When Alice sends to Bob, instead of using Bob's main public address, Alice uses some public info from Bob, a meta address, to mathematically generate a brand new, unique, one-time use address just for this transaction.
A stealth address.
Exactly. The funds go there. Only Bob, using the private key linked to his meta address, can ever access or control the funds sent to that stealth address.
Like a disposable secret mailbox, only Bob has the key to.
That's a good way to think about it. It breaks the public link between Alice's address, Bob's main address, and this specific transaction.
Okay, and the third one, fully homomorphic encryption, FHE. This sounds like the most complex.
It is conceptually quite mind-bending. FHE allows you to perform computations directly on encrypted data without ever decrypting it.
Compute on ciphertexts.
Yes, and the result of the computation is also encrypted. Only someone with the secret decryption key can see the final plaintext result.
Can you give an analogy? The report mentioned a puzzle.
Yeah, imagine assembling a jigsaw puzzle where every piece is covered by an opaque seal. With FHE, someone could tell you piece A connects to piece B based only on their shapes, the computation, without breaking the seals. You assemble the whole puzzle, still sealed. Only you, with the key, can then remove the seals and see the final picture.
Wow. How could that apply to tokenized assets?
You could potentially do things like verify transaction validity, does Alice have enough encrypted funds, or update aggregate balances on-chain, all while the amounts remain encrypted.
So how would an FHE transaction work on-chain?
Alice would encrypt the transfer amount using an FHE scheme. That encrypted amount goes into the transaction. The network, using FHE's properties, performs checks on the encrypted data confirming validity, executing the transfer by updating encrypted balances, all without decryption.
And again, only Alice and Bob can decrypt their final balances.
Correct, using their private keys.
The report had these radar charts comparing these privacy methods. What did they show?
They were really useful visuals. They plotted each solution, ZKPs, FHE, stealth addresses, etc., against key features. Anonymity, confidentiality, scalability, flexibility, trust minimization.
Rating them low, medium, high.
Exactly. It clearly showed the trade-offs. No single solution is perfect on all dimensions. ZKPs might score high on confidentiality but have computational overhead. Stealth addresses are great for sender-receiver anonymity but don't hide amounts. FHE offers strong confidentiality during computation but faces scalability challenges. It highlights that the best choice depends on the specific use case.
Okay, that covers the privacy tech. Let's shift to digital identity again. What were the main approaches discussed in the report?
The core idea is enabling individuals or institutions to hold digital attestations like credentials or proofs from trusted sources, things you can selectively share to prove something about yourself. I pass KYC, I'm an accredited investor, etc.
Secure, private, verifiable trust.
That's the goal. The report looked at a few key concepts: verifiable credentials, VCs, and decentralized identifiers, DIDs, are big ones.
VCs are the digital certificates, DIDs are the user-controlled IDs.
Pretty much. VCs are issued by trusted authorities. DIDs give the user control over their identifier. You'd use trust registries to manage who can issue what and how VCs are verified.
Okay.
Then there are soul-bound tokens, SBTs, non-transferable tokens representing an attestation tied to an identity. NFTs could also represent identity claims, though transferability might be an issue. And finally, on-chain claims, where the attestations themselves are stored on the blockchain.
But storing identity claims on-chain brings back that privacy issue, doesn't it?
Absolutely. That's a critical point. You can't just put raw identity data on a public chain. This is where on-chain privacy techniques must apply to identity solutions, too.
So, using ZKPs for identity.
Exactly. Identity ZKPs. You could prove you hold a valid KYC credential from trusted issuer X without revealing the credential itself or the PII within it. The ZKP just proves possession and validity.
And FHE could play a role too.
Potentially, yes. You could store encrypted attestations on-chain. Verifiers could then run computations against these encrypted claims, maybe checking if an accredited investor flag is set to true without decrypting the underlying claim data.
So it's not just the tech, it's building trust in the whole system,
Yeah.
especially for VCs and DIDs.
Totally crucial. You need a solid business approach, agreement on standards like the W3C VCDIB specs, clear rules about who are trusted issuers, standard formats for things like AML letters.
And practical things like being able to revoke credentials.
Essential. If someone's status changes or a credential was issued in error, you need to be able to revoke it reliably. And ensuring non-transferability for certain types of credentials is key to prevent misuse.
So what are the absolute must-haves for enabling this kind of on-chain privacy-preserving identity?
Okay, first, it needs to be compatible on-chain. The identity layer needs to live and breathe on the blockchain alongside the tokenized assets so they can interact programmatically.
Makes sense.
Second, privacy preservation is non-negotiable, especially on public chains for institutions. PII stays confidential. ZKPs and FHE are the likely enablers here. The report really stresses integrating identity solutions with privacy tech from the ground up.
So the report tested these ideas using specific fund use cases.
Yes, they picked 3 progressive scenarios to really compare how different privacy and identity solutions performed.
What are they?
Use case 1 was basic: private delivery versus payment DVP settlement for a fund subscription. The need: keep the transaction amount, token type, and investor address confidential, like an institution buying into a fund privately.
Okay.
Use case 2: reusable, privacy-preserving on-chain identity for onboarding. The idea: verify once, get a VC, then use private ZKP-based claims derived from that VC for future fund onboarding without resharing all the data.
Streamlining KYC.
Exactly. And use case 3 looked at new applications built on top, specifically secondary markets. How could an investor privately sell fund units to another pre-verified buyer, automating compliance checks using the on-chain identity infrastructure?
Testing composability with privacy and identity baked in.
Precisely.
And they had overarching requirements too, business and technical.
Yeah. Business needs included things like selective disclosure, revealing some info if needed, atomic WP, asset and payment swaps simultaneously, and still having some form of block explorer validation that respects privacy.
And technically.
They looked at things like: is it open source? How much trust do you need in central parties? How similar is development to standard EVM work? How flexible is it with identity data? And importantly, performance: was it feasible?
And they ran an end-to-end test workflow with different providers.
Yes. Simulating a fund manager setting up funds, verified investors subscribing using on-chain cash and digital identity checks, and then a separate secondary market app where those verified investors could trade, maintaining privacy and composability throughout.
Which providers did they work with on the privacy tech side for these tests?
They had several. Zama, using FHE and stealth addresses. Kinex's own internal applied research team with PayDL, using ZKPs. Ava Cloud, exploring ZKPs, distributed homomorphic encryption and stealth addresses. Parkin's Rails Tech, using segregated ledgers. And Phoenix, focusing on FHE for Layer 2 Ethereum.
A good range of approaches.
Okay.
Let's get to the findings. What did they conclude about zero-knowledge proof after these tests?
ZKPs came out looking very interesting. Their strength is enabling those critical verifications: eligibility, transaction validity, compliance rules, while keeping data confidential.
And they're already used in production.
Right, that's a big plus. They're live on various blockchains, and you can often implement them without needing fundamental changes to the blockchain itself.
What are the core capabilities highlighted?
Anonymity and confidentiality for transactions, proving things without revealing data, and flexible auditability. Regulators could potentially be given specific keys to view certain data if needed.
Technical benefits.
Scalable anonymity, good composability, usable on existing chains. Implementation-wise, they benefit from growing developer tooling like CKDSLs, and things like relayer services and stealth addresses work well with them.
But there are challenges.
Definitely. Adapting current fund processes to use ZKPs isn't trivial. There are computational costs. We still lack industry-wide cryptographic standards for ZKPs. Smart contract integration isn't fully standardized. Client-side computing power can be a factor. And ensuring the services that help submit ZKP transactions are sufficiently decentralized is important. The path to full industrial-scale use needs more work.
Okay. What about the findings on stealth addresses?
They were seen as straightforward and effective for specific privacy needs. mainly transaction privacy, hiding the link between sender and receiver for things like subscriptions or distribution.
Simple, compatible.
Yeah, relatively simple to implement and works with existing systems. Technically, they scale well, provide good anonymity for single transactions, don't need EVM changes. They manage identity linkage well without breaking transaction anonymity.
With any downsides.
The main challenge mentioned is cost on public blockchains, the gas fee for creating a new address for every transaction. Though some newer blockchain designs aim to mitigate or remove gas fees, which could help here.
And finally, fully homomorphic encryption, FHE. What were the reflections there?
FHE holds immense potential, especially for performing complex calculations on sensitive fund data, think NAV calculation, portfolio management logic, reporting while keeping everything encrypted.
And you could potentially upgrade existing contracts.
That's a theoretical advantage, yes. And it has clear uses outside blockchain, too.
But the challenges are significant currently.
Yes, the report flagged practical hurdles. It might require blockchain infrastructure changes for good performance. Scalability is still a major challenge. The complexity could slow down time-sensitive operations. Using off-chain processing for speed introduces centralization trade-offs. Development is complex. And while solutions for on-chain FHE are maturing, they're not quite ready for prime time across the board.
Okay, so summing up the privacy tech findings.
It seems ZKPs offer the most comprehensive feature set right now, but require work to integrate. FHE alone isn't quite there, but could be powerful combined with other methods. Stealth addresses are elegant and scalable for specific use cases like obscuring transaction links. The best approach really depends on the specific needs and the blockchain environment, especially costs like gas fees. Continued evaluation is key.
This has been incredibly thorough. So boiling it all down, what's the ultimate conclusion from Project Epic about the future of tokenized finance?
The absolute central conclusion is crystal clear. Getting enterprise-grade privacy, robust digital identity, and preserving composability on-chain are fundamental pillars. They are essential to fuel the future growth and unlock the full potential of tokenized finance.
Can tokenization grow without them?
Some growth, yes. Early steps are happening. But to reach that multi-trillion-dollar scale, to bring in the major institutions, you need these pieces firmly in place. They are the critical catalysts.
And a key takeaway on privacy specifically.
On-chain cryptographic methods like ZKPs and FHE offer stronger guarantees than just relying on off-chain controls. But you need to balance technical sophistication with practical deployment. The EVM innovation is exciting, but widespread adoption needs more work on computational efficiency, infrastructure needs, network costs, and common standards. And remember, the best privacy tool depends on the job.
And the main message on identity.
Reusable digital identity is crucial for the operational transformation promised by tokenization. But, and this is key, it has to be commercially viable. It needs to fit within existing trust frameworks, and there need to be real incentives for institutions to participate, maybe by making verification a valuable service.
Bridging old trust with new tech.
Exactly. Building that network of trusted institutions is vital. Success hinges on scalability, integrating with regulations, sustainable economics, and strong governance.
The report finished with a call to action, right?
Yes, they're actively inviting companies, projects, anyone working on institutional-grade privacy and digital identity for blockchain to engage in dialogue. They want to discuss the tech, standards, governance.
And they provided contact info?
Yep, kdagrowth@jpmorgan.com. They stressed Connex's own ongoing commitment here and invited others to join the journey.
Are there resources listeners can check out?
Definitely. They pointed to the Connex's Self-Sovereign Identity, SSI, SDK, for anyone wanting to build with DIDs and VCs following W3C standards. And they recommended keeping an eye on Connex's updates as they continue to explore and implement these solutions on KDA.
This has been a really fantastic deep dive. We've covered a lot of ground on some complex but absolutely vital topics for where finance might be heading.
It's definitely a space to watch closely.
Absolutely. So to wrap up, a final thought for you, our listener. Given this really intricate dance between transparency and privacy we've discussed for tokenized assets and identity, what unforeseen societal shifts, or maybe new regulatory challenges, could widespread adoption of these powerful technologies actually trigger down the line? Something to mull over. Thanks for joining us on the deep dive.